The Bitcoin danger zone is officially over. Are you familiar with this tweet, by the way? Because we've been talking about this tweet and this danger zone all the way back in late April, and we've seen all the historical tendencies take place. Nothing out of the ordinary is taking place as we see it. Things are progressing very nicely, repeating the 2016 cycle. History is repeating, so let's talk about it in a lot more detail in today's video. So subscribe to the channel for more videos like this in the future. Like this video if you enjoy content like this going forward, and let's talk about this tweet in a bit more detail. So the Bitcoin danger zone is a period of price action, essentially, that forms before the halving, and then we focus on the post-halving danger zone, which is a period of price action that forms after the halving. And historically, we tend to come up with a danger zone of 3 weeks. So it's a 3-week window where we tend to see downside volatility below the reaccumulation range low. And in this chart from late April, we didn't really see that yet materialize. But look at 2016. 2016 is where we saw downside price action in the 3-week window after the halving, where we saw downside wicking below the reaccumulation range low. And after the halving is typically when we see sideways price action for a long time, in fact, and that time can be up to 150 days, but that's a story for another day. But generally speaking, 3 weeks after the halving, we see lots of downside volatility, and in 2016, this downside volatility was 17%. And the thing is, we were expecting this sort of downside volatility in the 3 weeks after the halving. So typically your danger zone, essentially, the post-halving danger zone. And late April, we didn't really see any downside volatility, but we were already on track to getting a revisit of this reaccumulation range low. And of course, downside volatility below that range low was expected within that 3-week window. So how did things turn out? So if we just compare this 3-week window to this one, then of course we got this downside wick right over here. So talking about that initial tweet, we got the downside wick below the reaccumulation range low. This was 6% in this cycle. As we mentioned earlier in the video, it was 17% in 2016. Of course, differences in liquidity, differences in market cap, differences in a whole bunch of ways when it comes to 2016. After all, this is a market cycle that is 8 years apart, but nonetheless, simply stunning to see these historical tendencies play out in market cycles that are essentially 8 years apart, 2 halvings apart. So we know that the reaccumulation range lasts for up to 150 days. This was the case in 2016. So we still have a ways to go. We're only just 3.5 weeks after the halving. So this reaccumulation is going to continue happening, but we've seen a 14% move towards the upside since that bottom here. And we're still in the range low area, essentially, because this is a range between 60K to 70K, and we're still in the lower parts of this range. And this is not out of the ordinary, because after the halving, we also saw price just meander at the very bottom of this reaccumulation range. But the point I'm making is that the danger zone is over. Whatever the danger zone was supposed to achieve for us, and that is a downside wick below the reaccumulation range low, we've seen that happen, haven't we? We've seen this downside wick produce itself below the reaccumulation range low, and the danger zone is over. But the danger zone is also over from a time-wise perspective, because price-wise, we saw in 2016 that this downside wick occurred in the 3rd week of this danger zone. And here in this cycle, we saw that downside wick occur in the 2 weeks after the halving. So a slight difference there, some sort of acceleration in this danger zone, but 2 weeks in this cycle and 3 weeks in this cycle, just a week difference. History is still repeating. Although not picture perfect, but history is rhyming, and that's the point of it. It's not supposed to repeat picture perfect, it's supposed to rhyme, and rhyming is definitely what we're getting here. So price-wise, we saw the danger zone end because it satisfied that downside wick. But now that the new week is upon us, time-wise, this danger zone is over. So essentially speaking, the danger zone, the post-halving danger zone, which is a 3-week window where Bitcoin can produce downside volatility below its current reaccumulation range low, that danger zone is over. And that terror that occurs whenever we see downside volatility below the reaccumulation range low, that is also over. That terror is over, and the correction bottom is probably in because the danger zone is supposed to produce that bottom for us, and it looks like that has been the case indeed. We've seen a pullback from 71k, wherever that old all-time high, that new all-time high is. We've seen a 23.6% pullback, and that's the deepest one in this cycle, dating back to the bear market bottom of 2022. 23.6% downside over a period of 47 days, and the longest correction was probably this one. In fact, these two really, they're both 63 days long, both occurred. So essentially, if you measure from here to the bottom, that's 63 days. And if you measure from this top to the bottom here, that's 63 days as well. Two 63-day corrections took place within one reaccumulation range, but essentially we got two corrections 63 days long, and those two were equally the same length, equally the longest corrections. And if you just look at this from this top to this bottom, we were still a ways away from a 63-day correction. Let me just do this properly. We were 2 weeks away from a 63-day correction because we were essentially 47 days into this correction from top to bottom. And the reason I'm saying that this is the bottom of the correction is because the ingredients for a Bitcoin correction to be ending is for a deep retracement to occur and for a long retracement to occur. So we got the deepest one at 23.6%, but we got also one of the longest ones at 47 days long. So for lightning to strike twice and for us to get a long correction of 63 days, as well as the deepest one in the cycle, that would have required lightning to strike twice, and I was pretty confident that we only needed lightning to strike once and give us that deep correction, the deepest one in the cycle, but we didn't need the longest correction in the cycle as long as we had one of the longest. So one of the longest is, of course, this current one, 47 days, but it's not the longest. It's not 63 days long. We didn't need a longer one. The fact is that we got the deepest one, we got one of the longest ones, and that's pretty much all satisfying this danger zone, downside wick probably being the bottom, us protecting this range low quite nicely, and we're following history in that respect. The downside wick has occurred, it's over, the danger zone is over, but the reaccumulation phase that lies ahead is not over, and that's something we're going to be talking in the next video, what to kind of expect going forward, because this is a reaccumulation phase right now. We're probably going to be meandering between the range low and the range high, the 60 and 70k regions, just meandering here for the next coming weeks. As we've seen, this can be up to 150 days, as we've seen. At least 150 days, because a breakout actually tends to occur to end this reaccumulation range. So in fact, this red box should encompass this price action, but that will be in the next video. So subscribe to the channel, like this video, check out the top right hand video for more, and I'll speak to you in the next one. Speak to you soon.